Happy Wednesday out there, Team 42. It's your skipper here, Darius to present our macro minute for Wednesday, July 16th, 2025. Hope everyone's having a great week. So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following our KISS and Dr. Mo signals, you need to be a client of 42 Macro. So today's key macro question is, are markets adequately pricing in regime change at the Fed? Our answer, no. Kevin Hassett, the current director of the National Economic Council, is the early frontrunner to replace Jerome Powell as Federal Reserve Chair in 2025, per sources familiar with the process. Kevin Warsh, the former Fed governor whom President Trump passed over in 2017, citing hawkish policy views and a youthful appearance, is also atop the short list to replace Powell. Sources say Treasury Secretary Scott Bessent is helping vet Fed chair candidates, but may land the role himself if others fail to impress. Fed Governor Chris Waller is also a dark horse candidate. Unlike former National Economic Director Gary Cohn, who tried tempering Trump's tariff instincts, Hassett has taken a maximalist approach at the National Economic Council. He has embraced full MAGA orthodoxy, echoing Trump's hardline stances on trade, taxes, and the Fed in repeated media appearances. This is consistent with our view that President Trump prefers to surround himself with loyal sycophants. For our June 16th leadoff morning note, there has been a lot of good news on the inflation front in recent months. If Powell and his colleagues fail to adequately incorporate positive inflation developments via signaling an incrementally dovish positive policy outlook, both in terms of the timing and magnitude of rate cuts, we are likely to see President Trump move quickly to name Jay Powell's eventual replacement, someone our analysis suggests is likely to be an ultra-dovish sycophant. This right tail risk is not adequately positioned for by investor consensus at the current juncture. For our June 21st around the horn, in our view, the Fed's reaction function will transition from modestly dovish to asymmetrically dovish over the medium to long term due to pressure from the Trump administration that is not afraid to challenge the rule of law or long-standing institutions like Fed independence. The probability that Jay Powell is replaced by an ultra-dovish sycophant is not fully priced and represents substantial right tail risk for risk assets, short rates, and gold, and substantial left tail risk for the US dollar. Bonds would eventually sell off, prompting intervention like Fed yield curve control, but the likely U-shaped economy punts this risk at least a couple of quarters into the future. Elsewhere, UK headline CPI accelerated in June to its highest since January 2024, led by a 4.4% spike in food CPI, the highest since February 2024. These data are triggering a backlash over labor's payroll tax and minimum wage hikes in April. Rising labor costs from April's tax and wage hikes have forced businesses to hike prices, amplifying inflationary pressure. Recall that both the US and UK are deep twin deficit economies that are being run hot from a fiscal and monetary policy perspective. Also recall that the US economy is growing faster than the UK at 2% year over year in Q1 versus 1.3% in the UK, and tracking at 1.7% in Q2 versus only 1.1% in the UK. With UK real GDP growth running well below trend, this is a signal that US businesses may also feel confident in passing along policy-induced supply chain inflation to consumers as well. Transitioning to our 42 macro dashboard, as always, wrap up with a question from our community. This one's titled Bitcoin. Not really a question, but a series of comments that I think embellish what our clients are doing here to take our KISS and Dr. Mo signals and customizing those signals to suit their own strategic investment objectives and also generate superior risk-adjusted performance in their own portfolios. So I'll just read the comments in order. It says, hi, Darius. I love the last couple of macro minutes, and they sparked a thought I've been having re Bitcoin allocation. For me, the reason I only have 10% Bitcoin was its volatility. However, with your risk management, the downside risk is so well managed, I'm starting to consider shifting some of my gold allocation to Bitcoin, i.e. doing a 60-20-20 portfolio. I know DD has his reasons for his portfolio recommendations, but I'd love to hear what others think. So briefly, just touching on that before I move on to the next comment. The reason we have a 60-30-10 portfolio, as we talked about, I want to say on Monday or Tuesday of this week, is to create a very short bridge between the most common static pie chart asset allocation out there, which is 60-40, to our dynamic pie chart asset allocation, which is KISS. So KISS is 60-30-10, stocks, gold, Bitcoin. And so we want to make that bridge as short as possible so that we can compete against what we see as quite frankly, not a particularly effective solution to help retail investors retire on time and comfortably. We've seen that throughout several market cycles already. Getting back into this, the next comment says, I've been having the same thought. I started following the standard KISS late December and has worked really well for me. I'm up 10% this year. Gold carried my portfolio earlier in the year. I agree with the downside risk being managed well. I think I may start buying the dips with Bitcoin up to 10% more allocated from gold. So again, this person's also suggesting a 60-20-20 portfolio. Going back to read the comment, my hesitation is my only hesitation is how quickly Bitcoin can change. I recently shifted 1/3 of the 60% stock allocation to QQQ. I'm not trying to be too greedy and ruin a good thing. Appreciate that. And then the final comment is I'm running a custom version of KISS, currently 80-20 Bitcoin AI stocks. And 30% of my 80% Bitcoin exposure is leveraged via MSTR, which is strategy, ETHW. I'm not familiar with that. Hood, I assume is Robinhood, etc. So these are all very high beta stocks that are incredibly correlated with the broader crypto asset price fluctuations. Getting back into the comment, as Bitcoin's price increases, I predetermined to take profits where I will reduce my leveraged exposure and raise cash, allocate to more standard KISS weightings. So my goal is to just keep buying more Bitcoin with profits. So man, this is brilliant. I'm so proud of what we're building here at 42 Macro. I'm so proud of the members of Team 42 for how thoughtful they are as investors. Again, I say the number one thing we sell here at 42 Macro are high quality, institutional grade risk management overlays. And we have clients from all over the world. These are 3 clients in 3 different locations all over the world talking about how they're taking our KISS signals and using that to expand their portfolio risk management, changing the target allocations from 60-30-10 to things like 60-20-20 or 80-20 Bitcoin AI. They're also changing the exposures as well in terms of reducing the amount of gold, increasing the amount of Bitcoin, completely eliminating or taking up Bitcoin 80% and replacing the 60% of stocks with only AI stocks. I mean, these are all very thoughtful ways to use our high quality institutional grade risk management overlays to manage your own customized versions of KISS. Like I said, KISS is eminently customizable. We run our 60-30-10 standard KISS portfolio because it is simple, only 3 ETFs. It's highly effective. Average annual return on the rolling out of sample back test since January 2018 is 25%, which is 2.5 times the average annual return of the 60-40 portfolio. And the maximum drawdown is half of what the 60-40 portfolio is with 12% versus, I want to say 22%. And by the way, you would have crashed twice. Your portfolio would have crashed twice since 2018 had you been long 60-40, as opposed to 0 crashes in KISS with that 12% max drawdown being the only double-digit drawdown since 2018 in the entire lifetime of the rolling out of sample back test, which begins in January 2018. So super proud of KISS. You don't need to customize KISS if you don't want to. If you just want to set it and forget it and participate in the standard KISS portfolio, be my guest. You're going to have fantastic results. If you want to customize KISS to your own liking because you want more risk in your portfolio, you want less risk in your portfolio, you will have different configurations in terms of the target allocations you want to try out to give yourself more or less risk. You have different configurations in terms of the exposures you want to try out in terms of U.S. equities or AI stocks or international equities or gold, silver miners, gold miners, Bitcoin, Ethereum, Solana, treasury bonds, short rates, investment grade credit, high yield credit. I can go on and on and on. All the information you need to do to manage that, all the institutional grade risk management overlays that we provide are right there in our Dr. Mo table for you to customize KISS to your liking to the extent that you don't want to participate in our standard KISS portfolio. So I can't think of a better solution for helping retail investors retire on time and comfortably than what we built here at 42 Macro. And I'm really proud of our clients for recognizing that and using KISS and our Dr. Mo signals to maximize upside capture in bull markets, minimize downside capture in bear markets, and ultimately help themselves retire on time and comfortably. So super proud of them, super proud of us. Thank you for listening. We'll catch you back here. I'm actually going to be traveling tomorrow and offline Friday. So we'll catch you back here on Monday. So everyone have a great week, have a great weekend, and we'll catch you back here on Monday. Cheers.